For many investors, mutual funds have become a popular way to build a well-diversified portfolio and have the benefit of active professional management. There are literally thousands of mutual funds available to choose from, so deciding on which ones to buy can be a challenge. But armed with some basic information and an understanding of the different fund categories available, you'll be in a better position to develop your investment strategy and asset allocation using mutual funds to build your portfolio. First, let's look at equity categories. Equity mutual funds can be broadly divided into 5 large groups. These large groupings could be investments in the United States exclusively, investments outside of the United States, or some combination of the two. These distinctions are often referred to as domestic equity funds for exclusively U.S. stock investments, and international equity funds for stock investments outside the United States, and global equity funds for stock investments anywhere on the planet. Aggressive growth funds are among the most risky equity funds. Aimed at maximum capital appreciation, they invest in companies with the potential for rapid growth. Aggressive growth funds may tend to favor smaller, fast-growing companies. Growth funds also strive for capital appreciation and do so by investing in companies positioned for strong earnings growth. In general, they are slightly less risky than aggressive growth funds. And growth funds may tend to favor larger, more well-established companies with good potential for growth, but probably not as fast as the aggressive growth funds might own. Growth and income funds attempt to provide both dividend income and capital appreciation. This category often invests in larger, well-established companies with good dividend-paying capabilities and sometimes may include some bonds in the portfolio as well. Balanced funds offer a one-stop shopping by combining stocks and bonds into a single portfolio. Sector funds concentrate on one industry, such as technology, financial, healthcare, or natural resources. Or a sector fund might focus on certain commodities, such as gold, natural gas, oil, or copper. Now let's look at fixed income categories. Bond funds can be divided into 4 broad categories: tax-exempt, taxable, high-yield, and money market funds. There are also international and global versions of these bond funds in the same manner as equity funds. Now, tax-exempt funds buy bonds issued by state and municipal agencies in the United States. Generally, for the United States taxpayers, these bonds are exempt from federal income taxes and may be exempt from state income taxes as well. Taxable income funds may invest in all other debt securities. Bonds in these funds are generally issued by the United States federal government or by its agencies, or a specific country's government in the case of foreign bond funds, and can also include bonds issued by higher-rated corporations. Companies such as Standard & Poor's and Moody's assign ratings of quality to bonds issued around the world. High-yield funds buy lower-rated corporate or municipal bonds. These bonds have a lower credit rating than the higher-rated investment-grade bonds and may have a higher risk of default, but will usually offer higher yields to compensate for the higher risk. Money market funds invest in highly liquid, short-term money market investments such as U.S. Treasury bills. These funds are most appropriate for short-term goals, such as a down payment on a home, since they're among the least risky investments you can choose. However, you should note that an investment in a money market fund is not insured or guaranteed by the Federal Deposit Insurance Corporation or any other government agency. Although the fund seeks to preserve the value of your investment at $1 per share, it is possible to lose money by investing in the fund. Also keep in mind that global and international funds can help you diversify your portfolio among a wide array of foreign stocks and bonds. However, international investments may involve greater risks that don't apply to domestic investments, including currency risk and political uncertainty. You should also note that some tax-exempt holdings may be subject to the federal alternative minimum tax, and capital gains, if any, are taxable for federal and in most cases state purposes. Understanding mutual fund categories is only the first step toward mutual fund investing. The next step is to match your personal goals, your time frame, and your risk tolerance to the appropriate fund categories, and to build an asset allocation that is right for you. Getting the right asset allocation for your individual situation can be a difficult challenge for many investors, so you may want to seek guidance from a qualified financial professional. Join us again soon for another installment of The Financial Briefing.